In every great financial cataclysm that has reshaped the modern world, in every market crash that has wiped out the savings of millions and plunged nations into despair, there is a secret that is rarely spoken of in polite company. It is the story of the winners. While the masses lose their homes, their jobs, and their futures, a small, almost invisible group of investors don't just survive the storm. They profit from it. Wildly. How do they do it? Is it luck? Is it insider information? Is it a conspiracy hatched in some smoke-filled room? The truth is both simpler and more profound. They are not predicting the future. They are recognizing the past. They understand that human nature, the intoxicating dance of greed and fear, never changes. And because of that, history on Wall Street doesn't just rhyme, it repeats with frightening precision. This repetition isn't random. It's a pattern. A 5-stage crash profit pattern that has been executed with devastating success by a handful of financial elites in 1929, again in 2008, and is, right now, being quietly assembled for the next great unwinding. They see the storm coming, they build their ark, and they wait for the flood that they know is inevitable. In this video, we will pull back the curtain. We will dissect this 5-stage pattern, not as a conspiracy theory, but as a masterclass in psychology, contrarian thinking, and historical awareness. We will walk in the shoes of the men who made fortunes betting against the world. And by the end, you will not only understand how they did it, but you will learn to recognize the warning signs that the pattern is beginning once again. To understand the pattern, we must travel back to a time of boundless optimism, a time known as the Roaring Twenties. It was the decade of jazz, of flappers, of economic boom, and at its heart was the greatest bull market the world had ever seen. Everyone was getting rich. Stocks, it seemed, could only go up. But in the shadows, a few lone wolves saw not a permanent new era of prosperity, but a bubble of historic proportions. This is where the pattern begins. Stage 1. Identifying the bubble, the mania of the Roaring Twenties. The bubble of the late 1920 seconds was fueled by two powerful ingredients, a new technology and easy credit. The new technology was the proliferation of the automobile, the radio, and electrification, creating a genuine economic boom and a narrative of endless growth. The easy credit came in the form of buying on margin. This allowed ordinary people to buy stocks with as little as 10% down, borrowing the other 90% from their broker. It was a massive accelerant. As stock prices rose, people borrowed more against their rising stock values to buy even more stock, creating a dangerous, self-reinforcing feedback loop. The market was no longer driven by fundamentals, but by pure, unadulterated speculation. Everyone was a genius in a bull market. But one man, Jesse Livermore, the most famous trader of his era, felt a change in the air. Stage 2. Building the contrarian position, the art of the short sell. Jesse Livermore was not an economist. He was a master market psychologist. As he described in the classic Reminiscences of a Stock Operator, he noticed the telltale signs of a market top. Blue chip, high-quality stocks stopped making new highs, while low-quality, speculative junk stocks were suddenly shooting up. It was a sign that the smart money was getting out, and the dumb money the public was rushing in for the final frenzied phase of the bubble. Instead of joining the party, Livermore began to do the unthinkable. He started to short sell the market. Short selling is a bet that a stock's price will go down. You borrow a share, sell it at its current high price, and hope to buy it back later at a much lower price, pocketing the difference. It's an incredibly risky strategy. If the stock keeps going up, your losses are theoretically infinite. Livermore didn't short everything at once. He began with what he called probe positions, testing the market's strength. When his small short positions started showing profits, it confirmed his thesis. He then began adding to his positions, building a massive bet against the entire U.S. economy. Stage 3. Waiting for the catalyst, the inevitable break. For weeks, Livermore's bet cost him money. The market churned at its peak, refusing to break. The pressure was immense. Everyone called him a fool for betting against American prosperity. But he held his nerve. He understood that a bubble of this magnitude doesn't just deflate, it bursts. It only needs a catalyst, a single pinprick to pop the balloon of collective belief. The catalyst came in late October 1929. A series of negative economic reports, coupled with signs of weakness from the London market, finally spooked the highly leveraged American investors. The selling started as a trickle, then became a flood. Margin calls were triggered. Brokers demanded their clients put up more cash for their loans, but the cash wasn't there. To meet the margin calls, investors had to sell their stocks, which pushed prices down further, which triggered more margin calls. It was a death spiral. Stage 4. Profiting from the panic, the Great Bear. As the world panicked, Jesse Livermore was calm. Every tick down on the ticker tape was a confirmation of his thesis. His massive short position, built over weeks, was now generating profits on an unimaginable scale. As millions of fortunes were wiped out in a matter of hours, Livermore's fortune swelled. On that single day, Black Tuesday, it is estimated that he made the equivalent of over $1.5 billion in today's money. He became known as the Great Bear of Wall Street. He hadn't caused the crash. He had simply recognized the unsustainable conditions and placed his bet accordingly. Stage 5. Buying from the ashes. The consolidation of wealth. The pattern doesn't end with the crash itself. The final, and perhaps most important stage, is the consolidation of wealth. While the public was ruined and forced to sell everything they owned for pennies on the dollar, those who had preserved their capital during the crash were now in a position to buy. Legends tell of investors like Joseph P. Kennedy, who famously got out of the market before the crash after receiving stock tips from his shoeshine boy. With their cash intact, these investors were able to sweep in and buy up stocks, businesses, and real estate at rock-bottom prices during the depths of the Great Depression. The crash for them was not a disaster, it was the greatest buying opportunity of a generation. Wealth wasn't destroyed, it was simply transferred from the panicked masses to the patient few. You might think the crash of 1929 was a unique event, a product of a naive, unregulated era. You might think we learned our lesson. But the pattern is not about regulations, it's about human psychology. Fast forward nearly 80 years to the mid-2000s, and we find the same 5 stages playing out again, this time on an even grander, more complex, and more global scale. Stage 1. Identifying the bubble, the housing mania. The bubble of the 2000s had a different narrative. It wasn't about stocks, it was about the American dream of homeownership. The belief was that house prices could never go down on a national scale. This belief was supercharged by easy credit, this time in the form of subprime mortgages. These were loans given to borrowers with poor credit, often with no down payment and no income verification. Wall Street then took these risky mortgages, bundled thousands of them together into complex financial instruments called mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, got the ratings agencies to slap a safe AAA rating on them, and sold them to investors around the world as safe investments. It was a system of breathtaking fraud and stupidity, a house of cards built on a foundation of bad debt, and almost no one was paying attention, except for a few outsiders. Stage 2. Building the contrarian position, the credit default swap. One of those outsiders was Dr. Michael Burry, a former neurologist turned hedge fund manager. Unlike Livermore, Burry wasn't a tape reader, he was a data cruncher. He did something no one else on Wall Street was willing to do. He actually read the prospectuses for these mortgage bonds. He discovered that they weren't filled with safe loans, but with ticking time bombs of defaults waiting to happen. To bet against this bubble, Burry couldn't simply short sell houses. He needed a different tool. He found it in an obscure financial instrument called a credit default swap, CDS. A CDS is essentially an insurance policy. Burry went to the big banks, like Goldman Sachs and Deutsche Bank, and paid them millions of dollars in monthly premiums for insurance policies on these safe mortgage bonds. The banks, believing the bonds could never fail, happily took his money, thinking it was the easiest profit they'd ever make. Burry, and a handful of others like him, were now effectively paying for fire insurance on a house they knew was about to burn to the ground. They were building a massive contrarian position against the U.S. housing market. Stage 3. Waiting for the catalyst, the subprime dominoes. For more than a year, Michael Burry's bet was a source of torment. As house prices continued to defy gravity, the value of the mortgage bonds he was betting against remained artificially high. The monthly insurance premiums he was paying were bleeding his fund dry. His own investors, seeing losses on paper, panicked and demanded their money back. They called him crazy. They threatened to sue. Just like Livermore, he was a lonely contrarian, fighting against a world consumed by collective delusion. But Burry held his nerve, trusting his data. He knew that the teaser rates on millions of subprime mortgages were set to expire in 2007. When that happened, homeowners' monthly payments would skyrocket and the defaults would begin. And that is exactly what happened. The defaults started as a trickle. Homeowners, unable to pay, began walking away from their houses. The market was flooded with foreclosures. House prices, for the first time in a generation, began to fall on a national scale. The dominoes had started to topple. The catalyst that turned a housing crisis into a global financial meltdown was the bankruptcy of Lehman Brothers on the 15th of September, 2008. Lehman was a 158-year-old investment bank, considered too big to fail. It was heavily invested in the very mortgage bonds that were now turning toxic. When the U.S. government made the fateful decision to let Lehman go bankrupt, it shattered the illusion that the authorities had everything under control. Credit markets froze. Panic went global. The pinprick had become a nuclear explosion. Stage 4. Profiting from the panic. The greatest trade ever made. While the world's financial system teetered on the brink of collapse, Michael Burry, John Paulson, and the other contrarians watched their thesis play out in spectacular fashion. The worthless insurance policies they had bought for pennies on the dollar were now worth billions. The banks that had sold them these policies were now legally obligated to pay up. John Paulson's hedge fund made an estimated $15 billion from the crisis in what has been called the greatest trade ever made. Michael Burry's fund, which had been on the verge of revolt, saw returns of nearly 500%. They had not been lucky. They had done the homework that no one else would. They had read the fine print. They had bet against the absurdity of a system that believed lending money to people who couldn't pay it back was a risk-free proposition. They had profited from the panic they knew was coming. Stage 5. Buying from the ashes, the bailouts, and the bargains. And once again, the pattern's final stage began. While ordinary homeowners lost their houses and savers saw their retirement accounts decimated, a massive transfer of wealth took place. The very same banks that had caused the crisis by creating and selling toxic assets were deemed too big to fail and received hundreds of billions of dollars in taxpayer-funded bailouts. This injection of capital allowed them to survive the storm. Then, armed with this fresh capital, they, along with savvy private equity funds and investors like Warren Buffett, were able to go on a shopping spree. They bought up smaller, failing banks for pennies on the dollar. They bought up vast portfolios of foreclosed homes to turn into rental properties. They bought stocks when the market hit rock bottom in March of 2009. The crisis, for those with capital and connections, was not the end of the world. It was a once-in-a-lifetime opportunity to acquire assets at fire sale prices, funded, ironically, by the public. Wealth wasn't destroyed, it was consolidated. 1929, 2008. Two different eras, two different bubbles, but the exact same five-stage pattern. Which brings us to today. After more than a decade of the lowest interest rates in 5,000 years of human history, and unprecedented levels of money printing by central banks globally, many of the world's most respected investors are now warning that we are living in the final stages of the largest financial bubble in history. Not a stock bubble, not a housing bubble, but an everything bubble. Stage 1. Identifying the bubble, the mania of the 2020 seconds. The bubble of today is not defined by one single asset. It is everywhere. Government debt has exploded to levels not seen since World War II. Corporate debt is at all-time highs. Stock market valuations by almost any historical measure like the Shiller P/E ratio are in the 99th percentile. And real estate prices in many countries have once again become completely detached from local incomes. This mania has been fueled by a decade of easy money from central banks, creating a pervasive belief that there is no alternative to risky assets and that central banks will always step in to prevent a major crash. Stage 2. Building the contrarian position. The smart money exodus. So where are the contrarians today? They are everywhere, if you know where to look. Michael Burry has been publicly and repeatedly warning of a market crash of generational proportions. Ray Dalio has detailed how the current debt cycle is mirroring the pre-crash period of the 1,930 seconds. But the most telling sign is not what they are saying, but what the smart money is doing. Central banks around the world are buying physical gold at a record pace, diversifying away from the US dollar. Corporate insiders are selling their own company's stock at the highest rate in years. A quiet exodus from risky paper assets into hard assets is underway, a classic defensive move that precedes a major downturn. Stages 3, 4, and 5. The unwritten future. We are currently living in the tense, uncertain period between stages 2 and 3. The bubble has been identified, the contrarian positions are being built, all that is missing is the catalyst. What could it be? A major corporate or sovereign debt default? A commercial real estate crisis? An unexpected geopolitical event that shocks the energy markets? No one knows the exact pin that will pop the bubble. But the pattern tells us what will happen when it does. There will be a moment of shock, a Lehman moment, where the authorities lose control. Panic will ensue. Margin calls will trigger forced selling, and as the masses are liquidated, those who prepared those who held cash, hard assets, and contrarian positions will see their opportunity. They will profit from the panic, and then they will come back to buy the world's best assets from the ashes, at prices we can only dream of today. The great transfer of wealth will happen all over again. It is tempting to view this pattern as a grand conspiracy, a game rigged by a shadowy cabal of elites. But the truth is more fundamental. This 5-stage pattern is not a conspiracy. It is a cycle, hardwired into the very fabric of our market-based system and our own human psychology. The cycle begins with a legitimate economic boom, stage 1, which attracts easy credit and speculation, creating a bubble. A small group of rational, independent thinkers recognizes the absurdity, stage 2. Eventually, reality intervenes and a catalyst pops the bubble, stage 3. This triggers our most primal emotion, fear. Fear leads to panic selling, which is what the contrarians profit from stage 4. And finally, at the moment of maximum pessimism, when everyone believes the world is ending, that is the moment of maximum opportunity, where the next cycle of wealth consolidation begins, stage 5. Greed, fear, panic, opportunity. The cycle is as old as markets themselves. Jesse Livermore, Michael Burry, John Paulson. They are not villains from a movie. They are simply students of history and human nature. They did not have a crystal ball. They had a script. A script written by the repeating patterns of past market cycles. You cannot predict the exact day or the exact catalyst of the next crisis, but you can learn to recognize the script. You can learn to identify the signs of a bubble, to understand the psychology of greed and fear, and to appreciate the value of preparing when everyone else is celebrating. If this deep dive into the crash profit pattern has given you a new lens through which to view the financial world, then subscribe to Economic Echoes. Because history doesn't give us a roadmap to the future, but it does give us the script to all the plays that have been performed before, and our mission here is to read them together.